Okay, so let's try and unravel a real Wall Street head-scratcher. You've got Netflix, right? By all accounts, they seem to be absolutely crushing it. But at the same time, their stock is in a total nosedive. So, how can a company be winning and losing at the exact same time? That's what we're going to figure out.
And I'm not just being dramatic here. I mean, you look at the headlines, you listen to the market chatter, you see the charts. They are all screaming that the Netflix empire is in some serious trouble.
I mean, just look at the scale of this drop. It is absolutely staggering. We're talking about a stock that has just cratered, falling almost 40% from its recent highs. It went from over $130 a share all the way down to around $85. That is a ton of value that just vanished. And it happened fast.
And here's the real paradox, the part that makes no sense. This whole collapse happened right after they put out what looked like a fantastic earnings report. They beat all the expectations, they've got more subscribers, and the market absolutely hammered them for it. So what on earth is actually going on?
All right, to get this, we've got to put on our Wall Street hats for a minute. We need to look at this from their perspective. This is the bear case, and believe it or not, it all boils down to a story about, well, deceleration.
So let's start with the good news, the numbers that should have made everybody happy. For the fourth quarter of 2025, revenue came in at over $12 billion. That's an 18% jump from the year before, and it beat what the analysts were expecting. I mean, by any measure, that is a fantastic number.
And on top of that, look at this. They now have a mind-boggling 325 million paid subscribers across the globe. That's a number that pretty much every other streaming service can only dream of. The kingdom is absolutely massive.
And the company, it's ridiculously profitable. Their earnings per share, that's EPS, was up 30% over the last year. These are not the numbers you'd expect from a dying company. No, these are the numbers of a machine that just prints cash. So, why is everyone freaking out? The whole answer, the key to this whole mess, is in this one single word: deceleration. You see, Wall Street is addicted to the rate of growth. It's not enough to just get bigger. It's about how fast you're getting bigger. And any kind of a slowdown, even if you're still growing, can totally spook investors. And this chart right here, this is the smoking gun. Just look at the trend. Back in 2025, revenue grew at 16%. Not bad. But now, their forecast for 2026 is only 11 to 13%. For a stock that everyone thought was a hyper-growth superstar, telling the market you're slowing down is like slamming on the emergency brake.
But wait, there's a huge elephant in the room, that massive all-cash deal to buy Warner Bros. And HBO. To pay for this thing, Netflix had to suspend its share buyback program. Now, for a lot of investors, those buybacks were like a safety net, always there to help prop up the stock price. Well, now that net is gone, so investors are looking at slowing growth and a super risky, expensive merger. It's no wonder they're running for the exits.
Okay, but while all this panic selling is going on, there's another side to this story. In the middle of this total bloodbath, one very famous investor, Cathie Wood, started buying millions of dollars worth of stock. This is the bull case, and it's a huge, bold bet on something called consolidation. This quote really gets to the absolute heart of her whole argument. The bulls, people like her, they believe the market is totally obsessing over these short-term growth numbers, and they're completely missing the massive long-term picture. Netflix is building an unshakable media empire. And she is definitely putting her money where her mouth is. While basically everyone else was dumping the stock, her ARK Invest fund swooped in and grabbed over $7 million worth of Netflix stock while it was on sale. That is a classic contrarian move, betting that the entire herd is just dead wrong. And the really critical point here is what they're building with this Warner Bros. Deal. Just imagine for a second having Squid Game and Wednesday living under the exact same roof as Harry Potter, Game of Thrones, and Batman. I mean, come on. This isn't just a content library anymore. This is basically a monopoly on culture itself. And that right there is the huge strategic shift. The game, for Netflix, is no longer about chasing every last new subscriber. No, it's about having a library of shows and movies that is so essential, so dominant, that you can just raise prices under 325 million captive customers, and they'll have no choice but to pay up. That, my friends, is called pricing power. Now, the second big part of the bull case is advertising. The forecast for the money they'll make from their ad-supported plans in 2026 is a cool $3 billion, and that's really just getting started. And you gotta remember, this isn't just any old revenue. It's high-margin revenue. That means once all the ad technology is built, it costs Netflix almost nothing to show you an ad, but advertisers will pay a ton of money to reach that massive audience. They actually expect this ad business to double in 2026 alone. So, this all brings us to the huge question about Netflix's future. Are we watching the birth of this untouchable monopoly that's just going to dominate everything? Or is this a company that's just bitten off way more than it can chew?
This table really lays it all out, side by side. You've got these two warring stories. The bears, they're completely zeroed in on the short-term slowdown and the big risk of that Warner Bros. Deal. But the bulls, they're looking way down the road at long-term consolidation, the content monopoly, and all the pricing power that's going to come with it. It's really a battle over what kind of company Netflix is even going to be.
And that's really the core of this whole problem. The market is having a complete identity crisis trying to figure out how to value Netflix. Is it still that crazy hypergrowth tech stock from the past? Or has it turned into a more predictable, mature media company? That transition is messy, and all that confusion is what's causing all this chaos in the stock price.
And look, if you look at how the stock is valued using a key metric called the price-to-earnings ratio, it has been squeezed all the way down to around 27. Now, historically, for a company like Netflix, that is cheap. Just about every time it's traded at this level in the past, it's ended up being a fantastic time to buy. The billion-dollar question, though, is this time different?
Which, of course, leaves us with the ultimate question for anyone looking at this whole situation. Is buying Netflix stock right now like trying to catch a falling knife? You're just going to get hurt? Or, as Cathie Wood is betting, is this the exact kind of mispricing that only comes around once in a decade? The answer to that is probably going to define the entire future of streaming.